This is very likely going to be the last video that I post in 2020. Thinking about taking the last week off to just spend some time, not really with family this year, but just spend some time to relax and kind of lay back a bit. But I want to say thank you to everybody for such a phenomenal year here on YouTube. Obviously, 2020 was not the brightest year for the world, but to me, all that tells us is that 2021 is going to be an absolute bounce back of a year. I could not be more excited for what's to come, and I do just want to say thank you for all the support over the previous year, and happy holidays, happy early holidays, and happy Merry Christmas. So today we're doing a video that's a little bit special. We're covering two stocks that I personally plan to buy in 2021. Different than stocks that I'm just generally liking at the moment. These are two stocks that I will very likely be adding to. Obviously not a certainty. Things may change, but we're going to be starting off with one Canadian stock that I currently own in my portfolio, and it's actually been a lagger. It's been a weaker performer, and that's one of the reasons why I'm looking to actually add to it. And the second is one that I do not own, but I've been wanting to own for a long, long time. Let's dive on into the video. If you enjoy, give this one a thumbs up. But our first stock today that we're covering is the company Rogers Communications, ticker RCI.B. And today we're looking at a yield of 3.41%. So a modest yield, but a nice one nonetheless. Today's shares are trading at $58. If we were to take a moment to compare Rogers up against its closest competitors, or its peers, we could say, a couple metrics that I am liking at the moment are price to earnings ratio. I mean, in general, one of the things that I like doing is kind of comparing amongst a similar sector. It's only fair, really, if you're comparing apples to apples in terms of the different types of companies. And amongst Rogers, Bell, Shaw, and TELUS, I mean, we do see Shaw showing the most attractive in theory, but an 18.9 PE versus a 22 for Bell and a 24 for TELUS. This is a stock that's piquing my interest. Again, we see dividends are lagging a little bit, but nevertheless, this is a stock that is on my radar. As a quick recap, the stock has been on a bit of a downtrend dating back to 2018, 2019. This isn't necessarily specifically COVID related, but of course their Q3 results that they posted, they're hit along with the entire sector. Earnings were down 14%, or net income, I should say. The top line as well was down 5% in the quarter, looking at it on a year-over-year basis. And to me, this is a chance where, this is just my philosophy on things. I personally understand that if I'm going to be owning a company, if this is one of the core parts of my portfolio over a 20, 30 year period, there are going to be months, there are going to be quarters, there are going to be years for that matter, where stocks underperform, the company itself or the business is not performing up to par. And that's something that's completely okay with me. In fact, when we do see sell-offs, this is something that if I believe the stock is of high quality, if I believe it's a company that's going to be around for a long time, it actually piques my interest, because with the company Rogers, they do operate here in Canada in a very unique space. We talk about it all the time, but they actually operate under or in an oligopoly. An oligopoly. It's funny, that term, when I looked it up, in Investopedia, they actually used the Canadian telecom sector as a prime example of that, noting Rogers, Bell, and TELUS. This is essentially when a specific company or a specific business has a lot of command. They really control a specific market. That would be a monopoly, I should say. A duopoly would be two, and then an oligopoly would be when there's multiple of them. So what that tells us is that when certain companies have such command over a specific area, they create very high barriers to entry for newcomers, for new competition into the space. It's very difficult for a company to come in and gain significant market share without the threat of even just being bought out. These companies have pretty deep pockets, and they're very willing to take on smaller providers. In fact, that's actually what happens. In the case with Rogers, they own Fido, for example. You could look at a number of different smaller providers that are actually subsidiaries now of a bigger parent company. When you come across a company in a position like this, it's not necessarily best for the consumer, because they have a lot of pricing. They have a lot of stuff they can do as a unit with pricing, and there's not many options. But as an investor, as a business owner, it's something that I'm typically pretty happy with. And that's why actually in my portfolio, you guys know I own Rogers and Bell. So those are the two stocks that I have chosen as my components. Nothing against TELUS. In fact, I may even say it could even be a better option. I think it has performed better. But the reality is this is two stocks that I'm buying, and Rogers happens to be one of them because the stock is lagging. A key reason as to why I'm liking Rogers at the moment boils down to their dividend safety. In terms of how reliable I believe this dividend is going forward, they pay a dividend of 50 cents per per quarter for every share that you own. That's obviously the equivalent of $2 per year per share. Again, today yielding 3.41%. They've actually bumped that up. If you look at the history, they've slowly increased that, and it has kind of remained in this 48 to 50 cents per quarter range. But the fact that they haven't been increasing it like crazy is actually, in my opinion, not a bad thing. Because if I compare this up to Bell and TELUS, Rogers is currently sitting at a payout ratio of 63%. Very, very manageable in my opinion. Whereas if you looked at Bell Canada, which does pay a higher dividend, but they're actually paying out over 100% of their earnings at 130%. You could look at TELUS too, which is also above 100% at 112% of earnings. This to me shows a little more reliability. And I compare that up with the PE ratio and looking amongst the different options, it kind of has me leaning this way if I'm going to be nibbling at some more shares. One thing to consider is that if these stocks were to cut their dividend, especially given the current state of our world and the environment that we're living in, I think it's not a bad idea to lean on the safe side, because if these companies continue to struggle and a company like Bell or TELUS or Rogers for that matter had to cut their dividend, you would be quite certain that the share price would suffer severely. We just saw that with RioCan, where they sliced their dividend by 33%. They dropped by a third as well. So it's kind of just playing a safer option at the moment. There's a quote that I came across by Benjamin Graham, one of the investors that I very much look up to. He quotes that the dividend record, one of the most persuasive tests of high quality companies, is the uninterrupted record of dividend payments going back over many years. We think that the record of continuous dividend payments for the last 20 years or more is an important factor of the quality's company rating. Indeed, the defensive investor might be justified in limiting his purchases to those meeting this test. This is an excerpt or a quote taken from The Intelligent Investor. And that's exactly my thought process on this, is that I'm willing to accept the lower dividend at the given moment. I'm not pulling this income out and living off it at the moment if it's going to mean a more sustainable longer term dividend. And again, I'm not saying that Bell and TELUS are going to screw their dividends. I do own shares of Bell, as I mentioned. However, this is just kind of the thought process that I'm thinking about at the moment. In terms of the financial health metrics, something that I do like to see is that their debt to equity ratio has been contracting. It's been slimming down. This is obviously a good sign. Current assets have increased. As we can see over the past few years, their current ratio is actually now above 1. So they've doubled that over the past few years. And even their financial leverage has come down. So from it being as high as 5.3 times down to about 3.9 where we sit today. And as I mentioned, this is one of the stocks that I feel quite comfortable with in my portfolio, with a mix of growth and dividends. And because it's one of the few positions that is down in my overall portfolio, the markets have really been powering through. It's just one that piques my interest at the moment. That's just really kind of what's going through my brain. This is without question not a stock that is going to be blowing up for me and making me a millionaire overnight. I got other components of my portfolio that I can try to hope for that, more or less. But in general, hey, I'll be happy to accept the modest dividend in the meantime, take advantage of some of this weakness, as I believe this is a company that I'd like to hold for the long term. The stock today, again, trades for $58.60 Canadian, and this is one that I'm going to be nibbling at going into 2021. On to stock number 2. This is one that I've mentioned I've wanted to own for the longest time. I've been really watching this stock for 3-4 years now, and I've just never justified. I've never found a time where I wanted to buy into it. And hey, in hindsight, it may have been good to buy back then, but it's now one that is starting to pique my interest. I'll be monitoring it closely over the coming year. It's the company Lockheed Martin, ticker LMT. And this stock trades for $352. These are a US traded stock. So these are US dollars. And you do see a nice dividend actually up at about just shy of 3%. This is the company, if you're not familiar, that is involved in the defense side of things. They make the big F-35 fighter jets, probably what they're most well known. They're actually the largest defense contractor globally. And of course, their biggest customer happens to be the US government. When people tend to think of Lockheed Martin, they do just tend to lean towards the fighter jets and they think that's all that they do. But that is so far from true, because their business, well, they break it up into 4 main categories or 4 main sections of revenue. We have the aeronautics, which would be the plane side of things, missiles and fire control, rotary and missile systems, and then space control. As you can see, actually a pretty decent diversification, a decent spread, and actually well diversified amongst their segments. Here's just a nicer way of looking at that in a, pie chart form. These always look better to look at. In recent news, which will kind of lead into why I like this stock, some things that came out just this past week alone was they announced one of their biggest takeovers ever. This is a $4.4 billion takeover in the space and missile area. This was their biggest acquisition over the past number of years, I believe going back as far as a decade. And this to me shows that they're emphasizing the buildup and the complementation of other areas. This is actually an area that is of high priority right now by the Pentagon in hypersonic missiles and being able to defend against certain other countries. So that's something we like to see. They just secured a $900 million contract on a maintenance deal for the F-16 fighter jets. This was dated December 14th, so 10 days ago. And they also just landed a deal with the US Navy to help aid in a missile program. This is to be completed by 2025. This was 2 weeks ago. So a lot of just news releases that are constantly being poured out with this company. And that's what actually leads into 3 reasons as to why I've always wanted to own this company and why in particular I'm liking the stock at the moment. The first reason is in regards to how this business model operates. This is actually quite common for the defense segment of things. They operate with very long-term contracts. And when I say long-term, I'm not talking about a year or a couple years. I'm talking about multi-decade contracts. These are major initiatives and major programs in place that expand over long time frames. For example, the F-35 program, the F-35 fighter jets, this goes through to 2070. And there's an expected amount of about $1.5 trillion that's going to be invested and put into this area. It's a major deal that they're working through. In fact, actually, the F-35s represent about 30% of total revenues. So a big component. And when you have these contracts in place, when you have these long-term contracts for supplying and then repairing these planes or big parts, there's a lot of predictability in this business model. Reason number 2 is that this is an area, a unique area, which is non-cyclical. It's not closely tied to how the economy's performing. You could even call it acyclical, how it's independent of, whether the economy's doing well or not. Because the government needs to put such and such dollars here, they have a specific budget that they allocate towards, defense or how much they're spending. I know that does vary, but to have the backing from the government, to have the backing from the military, which is a major part of how this nation, well, not our nation, but the US nation operates, that's huge. This is a company that wasn't crazily affected by the pandemic, as with a lot of companies that have to shut down business and have to shut down their, close their doors. One of the things that you can factor in and make a con for this is that, political parties have their different opinions and they all have different stances in terms of how much they want to allocate to defense. And one of the talks that you hear now is that with Biden coming into presidency, this is a terrible news for a company like Lockheed Martin. You don't want to buy the stock right now because they're not as generous when it comes to this space as someone like Trump. I'll touch more on that later, actually, as I summarize this video. But the third thing that I think is just, to me, why I love this stock so much and why I've always wanted to own it is that not only does this stock provide you with good growth, this is a premier dividend paying stock. I know you may be thinking that a 2.95% yield is nothing crazy. And I mean, it's still a great yield. That's 3% yield, but it's no 5, 6, 7% yield. But this is a company that's been growing it at 19 consecutive years. And not only increasing it and growing it, they've been growing it at a healthy clip. In fact, the 5-year growth rate is up in the double digits. So they're actually bumping this up and doing also with a 42% payout ratio. This has, to me, always been one of those dividend stocks that I've had on my watch list. It's one that I've always wanted to look into and buy, but I just never thought the time was right. And now that the stock is selling off for these few reasons, it's one that's really piquing my interest. This, to me, is actually a good example of how I approach stocks like this and how I approach really the stock market in general as a long-term investor. Again, these are stocks for me, and I'm looking out multi-decades for my holding periods. You could make the argument that, yeah, we're seeing all this weakness in the stock because of it's an election year and because we're going to have all these changes and because COVID. Like, you could really make whatever argument you want. And the reality is, I don't think we always know why a specific stock is dropping sometimes. Sometimes it's just, sometimes that happens. But I don't like to let that sway my investment decisions for the negative. In fact, when I see stuff like this, if the stock is selling off because of the election and because there's a new party in power, I say bring it on, because I can then actually get my hands on a stock that I've wanted to for a long time. If I'm going to be holding a stock like Lockheed Martin over 30 years, there's going to be different presidents that come in and out, and there's going to be different stances and different beliefs and views and opinions when it comes to spending. I know that's a big area just people are thinking about. I'm not going to play the game and jump in and out and wait for this or that. Hey, if the stock drops down like it has been showing, it's one that will start picking up on my radar. One thing that I do consider, tying this back to the title of today's video, and these are stocks that I'm personally buying, it is one that I need to watch for a little while, because I do also own the stock Raytheon, and it's actually one of my larger positions at the moment. It's first of all done well, and I also added to the shares, so that represents a decent component, and they're in a very similar sector. They're actually very similar companies, you could argue, both in the defense side of things. So personally for me, I have to think about how this is going to fit in, how this is going to mesh into my portfolio. I don't want to be super weighted in certain sectors and actually above my caps or above what my target weightings are. So that is one thing to consider. And it's actually why I haven't bought the stock yet, but it's one that I'll monitor. It's going to be a long 2021, and who knows, stock could continue dropping down further. There's no rush to buy the stock this immediate second, but it is one that is highly on my watch list. So that is the company Lockheed Martin, ticker LMT, with the 3% dividend yield. And that, ladies and gentlemen, will be a wrap for the last video of 2020. I believe I may throw it in, but planning on taking the week off. Yeah, just kind of relaxing. I think that would be a good plan for the end of the week. What do you guys think of my picks? Do you like them? Do you dislike them? You can leave a comment down in the comment section below and let me know. Do you own these stocks? I know some of you guys will own LMT. It's not one that gets a lot of coverage online, but I think it's actually a phenomenal option. Give this video a thumbs up if you enjoyed, because that is a great way of showing your support. You can subscribe for more content, because we post videos like this every single week. Well, not for the next week. There's going to be a week break, but this 2021 year is going to be crazy. It's going to be the craziest year. I can guarantee you of that. I'm so excited for it. But hey, Merry Christmas to everybody. We do have our Investing Academy down below. If you are looking to learn the stock market as a New Year's resolution, or you want to jump in right away, or you want to do it in 2021, whatever the case is, click the first link down below for courses and training. We have a program that takes people here in Canada from absolute beginners through the entire process of setting up your accounts, building a good diversified portfolio, and really just understanding what it's like to be an investor. We've had it's such a great group of students. It's crazy. The wishes, the holiday little greetings that we've got over the past couple days. It's just a phenomenal group of people. And if you want to join that community, there's a link down below where you can learn more. But as always, I thank you guys for watching. I wish everyone a Merry Christmas. And again, thanks for the support over a crazy 2020. It's been great. I'll see you guys in the new year.